Hello everyone, my greetings to one and all. This is the fifth and the last session on money and banking. In the previous session, you have understood how RBI is a banker to banks. I am Poonam Vohra, and in this session, you will learn about how RBI is a controller of money supply in the economy. RBI needs to ensure that a nation's economy remains healthy. One way central banks accomplish this aim is by controlling the amount of money in circulation. Their tools include influencing interest rate, setting reserve requirements, employing open market operations tactics, among other approaches. Having the right quantity of money in circulation is crucial to ensure a stable and sustainable economy. Let's understand how does RBI performs this function of controlling money supply. Let's begin. RBI is the controller of money supply in the economy by quantitative as well as qualitative instruments. Let's focus on quantitative instruments first. It comprises of repo rate, open market operations, and legal reserve requirements. Let's understand these terms. Repo rate is the rate at which central bank lends short-term money to the banks against securities. There is reverse repo rate also, that is the rate at which RBI borrows money from commercial banks. Increase in repo rate decreases the money supply and vice versa. Open market operations. It means buying and selling of government securities by the central bank from or to the general public and the commercial banks. Sale of government securities reduces the reserves of commercial banks and adversely affects the bank's ability to create credit, and hence decreases the money supply, and vice versa if it is purchase of securities. Legal reserve requirements. According to variable reserve ratio method, commercial banks are obliged to maintain reserves. They are required to maintain reserves on two accounts. One, cash reserve ratio, that is a minimum percentage of net demand and time liabilities to be kept by the commercial banks with the central bank. An increase in cash reserve ratio reduces the excess reserves and limits the credit creating power. And two, statutory liquidity ratio. It refers to the minimum percentage of net demand and time liabilities with commercial banks themselves. Here also, an increase in statutory liquidity ratio reduces the ability of banks to give credit and vice versa. How does quantitative measures adopted by RBI affects the money supply in the economy? This aspect we shall discuss in few moments. The qualitative instruments of Reserve Bank of India includes margin requirement, moral suasion, and selective credit control. Let's understand these one by one. Margin requirement is, as per the margin requirement, margin is the difference between the amount of loan and the market value of security offered by the borrower against the loan. Let's understand this aspect. If margin fixed by the central bank is 40%, then commercial banks are allowed to give loan only up to 60% of the value of the security. By changing this margin requirements, Reserve Bank can alter the amount of loans made against securities by the banks. So an increase in margin reduces the money supply, and fall in margin encourages the people to borrow more. Next is moral suasion. Moral suasion can be used both quantitative as well as qualitative credit control. Generally, central bank succeeds in convincing the banks as to act as their lender of last resort. It is the moral persuasion of central bank to the commercial banks to follow the advice as given by the central bank. Next is selective credit control. Under selective credit control, RBI gives directions to other banks to give or not to give credit for certain purposes to particular sectors. It can be applied in positive as well as in negative manner. In positive manner, it means using measures to channelize credit to priority sectors only, like exports, agriculture, small-scale industry, and so on. In negative manner, it means to restrict the flow of credit to particular sectors. RBI controls money supply during economic fluctuations. If there is inflation in the economy, the purpose is to reduce the money supply, and for that, RBI will adopt quantitative as well as qualitative instruments. So far as quantitative instruments are concerned, there will be an increase in repo rate. It implies an increased cost of borrowing from the central bank, and the commercial banks will not find it feasible to borrow from RBI, rather would like to park their funds with the central bank. With this, the loanable funds gets reduced and hence money supply gets controlled. Similarly, there will be sale of securities by RBI. That means the money will be taken away from the commercial banks when RBI sells its securities. So if amount is spent on the purchase of securities by the commercial banks, they are left with less amount of loanable funds. So money supply gets reduced. Also, there will be an increase in cash reserve ratio as well as statutory liquidity ratio. That is, a minimum percentage of the deposits to be kept with RBI as well as with the commercial banks themselves. If this minimum percentage is increased, that means more amount needs to be kept as reserves with RBI as well as with themselves, and the commercial banks will then left with less amount of funds to provide loans to people. So money supply gets reduced. Similarly, the central bank may adopt qualitative measures, that is, may increase the margin requirement, may provide moral suasions in order to reduce the credit, or may adopt selective credit control measures to provide credit only to the priority areas. So, by adopting various measures, money supply gets reduced and inflation gets controlled. Similarly, if there is deflation in the country, then the aim is to increase the money supply. For that, RBI would decrease the repo rate so that it becomes cheaper for the commercial banks to borrow money from RBI and also offer loans at lesser interest rate to the borrowers. So, by decreasing the repo rate, cost of borrowing will be less and more funds will be borrowed and money supply gets increased. RBI will purchase the securities in case there is deflation, as purchase of securities imply more money will be pumped into the system and hence money supply gets increased. There will be decrease in the legal reserve ratios, whether it is cash reserve ratio or statutory liquidity ratio. It implies that less amount needs to be kept as reserves with Reserve Bank of India as well as with themselves. By doing so, the commercial banks will be in a position to lend more money to the borrowers. So far as qualitative instruments are concerned, RBI will reduce the margin requirement, will direct the banks to provide more funds. By adopting all these measures, money supply gets increased and deflation controlled. Now assess yourself and identify the correct answer. The process by which RBI protects the economy against adverse economic shocks is protection, stabilization, sterilization, or liberalization. The correct answer is option C. The process by which RBI protects the economy against adverse economic shocks is sterilization. Summarizing the functions of the central bank, that is Reserve Bank of India, it is a supreme monetary institution of the country. It has the sole authority to issue paper currency. It leads to uniformity in note circulation, enables credit control, ensures public faith, and helps in stabilizing internal and external value of currency. RBI as a banker to government maintains current account, accepts receipts, makes payment, carries out exchange, remittances, gives loans and advances for temporary periods. As an agent, it has responsibility of managing public debt. As a financial advisor, it advises government from time to time on economic, financial and monetary matters. RBI as a banker to bank is required to keep a certain proportion of their deposits, like cash reserve ratio. As a lender, it gives loans and advances if they fail to meet their financial requirements. As a clearing house, it settles claims of various banks against each other by making debit and credit entries in their accounts. So, it supervises, regulates with respect to licensing, branch expansion, liquidity, mergers and winding up of banks. Not only that, it is a custodian of foreign exchange reserves and stabilizes the external value of currency and balance of payments. Finally, it is a controller of money supply and adopts various quantitative as well as qualitative measures in order to control economic fluctuations like inflation or deflation in the country. With this, the session on RBI as a controller of money supply comes to an end. Also with this, the unit on money and banking gets complete. In this entire unit, you have understood various aspects of money supply, credit creation and functions of RBI. You have answered few questions also in between in each session. But these are just not enough. Answer all the questions as given in the assignments, whether they are foundational based or competency based. By doing so, you will have a complete grasp over the unit. So keep practicing, keep learning, and keep reading. The next session would be on next unit, that is determination of income and employment. Looking forward to see you in the next session too.